So good afternoon, dear members. Now we have today VCM on Union Budget 2021. We already had a detailed macro analysis on second last Tuesday. As part of the micro analysis of the budget today, we have a VCM on clause by clause analysis of the direct tax proposals in the budget. For handling the topic, we have a very expert faculty and a regular speaker of in Thrissur and he's from Kottayam, CA PRASANTH. And on the screen we have our own chairman, C. Anupji, chairing the session along with the very smiling VC, Vice Chairman C. Arin KK. Now, before moving on to the webinar, dear attendees, please make use of the question and answer link that is available in the Zoom platform so that you can address your queries. The same will be taken up after the presentation. Now, over to you, Chairman, for the formal welcome speech.
Thank you, C. Ajit. Good afternoon to all members. Faculty of the day, my good friend, CA Prasanth, senior members and friends. Welcome to the webinar on close by close analysis of direct taxes, direct tax proposals in the Union Budget. Friends, Budget 2021 was presented in the Parliament amidst an unprecedented pandemic that shook the global economy. Indian economy was also severely affected, as all of you know. GDP growth was almost negative in a couple of quarters. However, the government seems to be determined to go ahead with reforms. The strategic disinvestment, for example, is likely to fetch the government a whopping 1.7 lakh crores for the year 21-22. So large-scale reforms are also planned in agriculture also. So no wonder the stock market rose by more than 10% in 3 days. So coming back to the topic, the number of amendments in direct tax laws this year is substantially less compared to last year, I think. Still, it is essential that a member should be aware about all the amendments. That is why we conduct a close-by-close analysis of direct tax proposals today. But there are certain amendments which I fail to understand the logic. Just to begin the discussion I'm telling, for example, the restrictions on due date of filing of IT returns, especially the belated returns. Previously, it was 31st of March of the relevant assessment year. Now it is cut short by 31st December. Why? What is wrong if someone wishes to file a belated return after, say, 1 year with tax, interest, and penalty? This is a common doubt of all professionals. Similarly, a couple of years ago, they introduced a gap of 1 month between the due date of tax audit report and tax audit report filing and the IT return filing. What additional benefit will it give to an assessee or auditor? See, this is yet another doubt. However, we are all happy that at least there is no additional cess as expected this year. Okay. Anyway, today we have a very learned young member from Kottayam, CA SRINIVAS. We have been keenly watching his sessions for the last few years. One thing I can tell you, CA Prasanth is steadily becoming one of the most sought after direct tax faculties in SIRC branches. I wish him all the very best. On behalf of the management committee and all members logged in today, let me welcome CA SRINIVAS to this webinar. I welcome all the members. Now let me invite C. Aryan, the Vice Chairman, to formally introduce the faculty. Over to you, Aryan.
Thanks, sir. Our Chairman, our other management committee members, Speaker of the day, members attending the Voices seminar, all of you, a warm good afternoon. It's my great privilege to introduce today's speaker, CA SRINIVAS from Kottayam. He's speaking on direct tax close by close analysis of budget proposals in the Finance Act. He born in a family of practicing chartered accountants and carries at his age of 43 the legacy of profession to the third generation. He married to CA Remya and they are blessed with 2 sons. Regarding his education and degrees, he took his BCom degree from Mahatma Gandhi University, Kottayam in the year 1997. He qualified as a chartered accountant in the year 1998 as a fellow member of the Institute of Chartered Accountants of India and holds diploma in information system audit. He's also an associate member of the Institute of Cost and Works Accountants of India. Right now, he is pursuing the Company Secretary's post of the Institute of Company Secretaries of India and also qualified intermediate. Regarding his profession, he is the partner of a firm founded by late Sri S. Srinivas Iyer in the year 1942 as Messrs. S. Iyer and Company Chartered Accountants Cooperative. Regarding his professional responsibilities in the firm, that include audit, consultation, filing of returns, and representing the income tax tribunals. He is also concentrated in bank audit assignments. His credentials include he has authored a handbook on taxation of charitable institutions. He is a member of the corporate allied laws committee of the Institute of Chartered Accountants of India, New Delhi, during the year 2006-7. He is also a member of the task force for Kerala state constituted by the Small and Medium Practitioners Committee, SIRC of ICA, in the year 2009-10. He contributed articles to various professional journals. He has presented papers at numerous professional forums. He has acted as resource person and teacher in direct taxes. He represents clients before various tax forums, including tribunals and other forums. And at the end of this shortlist, he is the managing committee member of Kottayam branch of ICA for the periods 2016 to 18 and currently 2019 to 21. He was also SICASA's chairman for the year 2017-18, 2018-19, and 2019-20. Sir, with these few words, let me introduce our speaker of the day, CA PRASANTH from Kottayam. Thank you all. Requesting Prashanth sir to start the session. Over to you, sir. Thank you.
Good afternoon. Thank you for the warm introduction.
Yes, sir.
Anup sir, Secretary Ajit, Managing Committee members Aryan sir, then my senior members, though I wish to be in person at Trichur and meet you all, but unfortunately we are all stuck because of the unprecedented COVID-19 pandemic, which has restricted our movements, which have restricted our interpersonal associations, which have restricted our acquaintances. So unfortunately, we are not able to be physically in touch, yet this online platform is helping us to be with all and to share and to enrich our knowledge. And I'm extremely thankful to the Trichur branch for giving me this opportunity to, in fact, I'll say it was an opportunity for me to learn the budget. Unless someone compels you to learn, it's very difficult because you this year's budget in particular, this was a pandemic year budget, and we expected a lot harsh measures in the budget. And watching the budget in the television was like having a sumptuous sadhya. The finance minister very calmly walked through the budget provisions, and most of the budget provisions were feel-good provisions. When she read out the tax proposals also, we felt, okay, fine, there are only 7 or 8 amendments which she read out. And most of these amendments, amendments ആയിരുന്നു. So felt, okay, fine. Once you got the finance bill in your hands, the jolt struck. Because the finance bill ran to about 300 pages. So I thought, okay, if it's difficult to read the entire 300 pages, let us see the memorandum explaining the finance bill. That itself was about 120 pages. Fine. And out of that, about 4 or 5 pages were GST. Then some provisions regarding customs was there. So after that, once you went to the direct tax proposals, I could see about 50 odd amendments in various provisions. I didn't make an attempt to count how many amendments. Anyway, there were about 50 odd amendments which touched upon almost all spheres. Like it is said, when the things appear to be very rosy, the devil will be in the details. Like that, when we read through the budget provisions, it is not as smooth as we perceived from the budget speech. many small amendments. And in fact, I would say most of the amendments are favorable to the department. Even settled laws are unsettled. Settled principles, settled judicial principles are challenged, and they are being unsettled. Procedurally, lots of revamps are being done. Now, I think we'll go through the provisions one by one. Most of the provisions are drafted in such a way, I may have to read out from the slides. I know it is very difficult to sit through a presentation where the speaker reads out through the PowerPoints, but I'm compelled to do that because most of the provisions are new, and not only new, each word carries a significance. So if you see broadly what are the amendments, tax rates are not touched. Fine. Company tax rate കുറയ്ക്കാവുന്ന പരമാവധി കുറച്ചു കഴിഞ്ഞു. Individual tax rates കൂട്ടാവുന്നതിന്റെ പരമാവധി കൂട്ടിക്കഴിഞ്ഞു. So no major surprises. We expected a corona cess, but that did not happen. Then other provisions, if we see return filing, total revamp, assessment procedures, total revamp, reassessment, total revamp, survey search and requisition of books, total revamp, settlement commission, total revamp, authority for advance ruling, it's gone, small dispute resolution committee, new provision. So procedurally, lots and lots of amendments are being introduced. Let us go through the presentation and see how the various clauses are going to have an impact on our practice. Lots of amendments are there regarding international taxation also. Since I don't know head or tail out of international taxation, only I have experience reading the provision and taking classes. I have no practical hands-on experience in international taxation except 195, section 195 certifications. So I did not venture into what are the amendments regarding international taxation. Lots of international taxation related amendments are there. It's like 7 or 8, if I remember right. 7 or 8 amendments are relating to international taxation. Those areas I have not touched upon in my presentation. Load ചെയ്യാൻ പറ്റുമോ PowerPoint?
പ്രശാന്ത് സാറേ,
ലോഡ് ചെയ്തിട്ടുണ്ടോ PowerPoint?
അല്ല സാറിന്റെ അവിടുന്ന് ലോഡ് ചെയ്തോളൂ.
ഇവിടുന്ന് ചെയ്യാമോ? ഓക്കെ, ചെയ്യാം. കാര്യം എന്റെ മറ്റേ സിസ്റ്റത്തിലായിരുന്നു, ഞാൻ ഇതിൽ ഡൗൺലോഡ് ചെയ്യണം നോക്കിയിട്ട്.
Dear members, it is not a technical issue. Our faculty is trying to connect to that PPT. Kindly bear with us.
It's better that instead of loading from our end, he can just do the same, sir. Oh, yes.
No, it's okay, Prashant. Yes, yes.
Continue.
Yeah, please.
Dear members, I'm very sorry. There was a little bit delay on account of the technical snag. I think I will resume. Broadly, what is envisaged is the proposals are classified under 4 different heads. This is what the government says. The proposals we classify it under rates of income tax, tax incentives, removal of difficulties. How far difficulties are removed, we have to wait and see. Rationalization of various provisions. What is rationalization? Rationalization in favor of the department mostly. So these are the broad heads under which the amendments are being carried out. Let us see them one by one. Rates of income tax, I've already told, no change is being made in the rates of taxes as per the Finance Act. Last year's Finance Act, the rates continue. Then rates as per the new sections, 115 BAA, BAB relating to companies, 115 BAC applicable to individuals, that special rate. Then BAD, 115 BAD applicable to cooperative societies. These tax rates are not at all touched. Then the growing concern is, in the last presentation at the branch also, I've highlighted that the high rate of surcharge applicable to individuals if they fall under the income slab of above 1 crore, 1 crore to 2 crores, above 5 crores, all these limits, they are paying huge amounts as surcharge. But if you have noticed this year's budget, one important change, not relating to income tax, one important proposal was there in the budget speech regarding the Companies Act. The Madam Finance Minister has said, we are going to relax the provisions relating to small companies and one-person company. So this we can use I don't say, I won't advise you should use. We can explore the possibility of using the corporate form as a mode of tax planning, considering the high rate of surcharge. 1% company, the turnover restriction was there, profit restriction was there, the capital restriction was there. All these restrictions are now no longer there. Now, why not convert a sole proprietor into a 1% company and use it as a device for tax planning? You can opt for 115 BAB, 22% tax, 10% surcharge. Instead of paying 42%, as he has 42% tax, why not we think about exploring a possibility? Don't just like that jump into that. And one important catch is there: if we convert a proprietary firm or a partnership firm to a company, the important thing is, if it is falling under very high profit brackets, then the requirement of CSR may come, corporate social responsibility spending may come, which may offset the savings which you make on account of taxes. So be careful, study the cases individually, study the cases thoroughly, and then only step into the possibility of a tax planning by converting a sole proprietor having huge profits into a 1% company or a small company. And one thing, take it from me, government has no regard for proprietorship or partnership. They want every business entity to be in the corporate form. The reason is, every year, if it is a company, you have to file a balance sheet and profit and loss account with ROC. So accounts of any entity will be with the government. So they want to ensure that. That's why they are giving incentives to companies and they are disincentivizing sole proprietary and partnership. And recently, one of my friends was telling, he's central statutory auditor of one of the nationalized banks. He was telling that bank is going to issue a guideline. If a borrower is having an exposure of more than 50 crores, then the accounts of the borrower shall be audited by a level 1 chartered accountant firm. Why? Because level 1 chartered accountant firm is compulsorily peer reviewed. So banks also are thinking in these lines. And this may naturally percolate down to other banks. It may percolate to various slab-based system of allotting, slab-based system of insisting upon audit of accounts of the borrowers. And other provisions, as once we come to the tax audit provision, as in Western countries, as in Gulf countries, audit may get shrinked to cater to the requirements of the persons who finance, be it shareholders, be it financiers. So days are not far away. The concept of statutory audit may go, and the audit for the sake of lenders, for the sake of financiers, such a concept of auditing may evolve in the near future. So first, let us see small amendments. Small amendments, we'll see them through. We'll focus more time and resources on the bigger amendments. This particular area is an important announcement made in the wake of corona pandemic. Leave travel concession. Finance Minister announced that this year travel restrictions are there. So we will give you cash equivalent of LTC. Whether the cash equivalent of LTC is eligible for exemption. The wonderfully drafted piece of exemption is now proposed. It says it is available provided you spend this cash component for buying goods or services which are liable for GST. Not only liable for GST, liable for GST at a rate of 12% or above. And you have to buy them from a GST registered person. Not only that, that payment for that procuring such goods or services should be through the banking channels. If all these conditions are satisfied, then 1/3 of the expenditure, subject to a maximum of 35,000 rupees, will be allowed as deduction. So this is one-time exemption. This is applicable only for this particular assessment year. Affordable housing, that exemption is already there, 80 IBA. To that, one more type of infrastructure project is included. This is, you construct houses for the purpose of letting them out. വാടകയ്ക്ക് കൊടുക്കാനായിട്ട് വീടുകൾ കിട്ടുക. വെറുതെ വാടകയ്ക്ക് കൊടുക്കാനല്ല, affordable rentals. Affordable rental. What is affordable rental? I don't know. But if you construct houses for affordable rental, this project is also now included in the purview of 80 IBA. And they have added one more line as a political statement, migrant workers. Because migrant workers, farmers, these are now selling points politically. So, migrant workers എന്നൊരു വാക്കുകൂടി അവിടെ ആഡ് ചെയ്തിട്ടുണ്ട്. So such a project is also eligible for 80 IBA deduction. Moreover, the sunset clause for getting approval from the competent authority expires on 31/3/2021. One more year is given. If it is approved by 31/3/2022, that will be fine. Conversion of urban banks to banking company. Last year, we remember an ordinance was brought about. No cooperative society, unless it is a bank, you can use the word bank. Namala Supreme Court decision Mavilai Bank in the favorable light ATP. But this is another issue. Urban banks already have RBI license, no issues. Service cooperative banks, society had to continue, bank had to continue. As per the ordinance, they can continue as society and they should not use the word bank. That is the ultimate implication. Now, the income tax aspect is something different. Income Tax Act section 44DB deals with restructuring of cooperative banks, amalgamation, reorganization, etc., etc., which specifies that in such a case, the transfer of undertaking is not liable for capital gains in the hands of the undertakings. Similarly, transfer of shares. If I hold shares in X bank and X bank gets converted to Y bank, that conversion of shares, if I instead of X bank share, I get back Y bank shares. So this transaction is not taxable for the purpose of capital gains in the hands of the shareholder. The same treatment is now being extended to conversion of an urban cooperative bank to a banking company. A small bank, finance bank, pala urban bank plan change to enable this to make this transaction tax neutral. This particular provisions are introduced. Strategic disinvestment. Many PSUs are going to be disinvested and money is going to come in, which is going to be used for various welfare measures. So we are also happy. Now, what is the tax impact when a PSU is strategically disinvested? Now, first of all, we should know what is strategic disinvestment. Strategic disinvestment means two things: diluting the government control below 50% and handing over the control to the buyer. Stakeholding 50% control is given to the buyer. This effect, first of all, government company will be demerged. Government company will be demerged, and after that, disinvestment is going to take place. So, to enable that, the definition of demerger is proposed to be changed. Demerger includes strategic disinvestment, and as a result, strategic disinvestment, there will not be any capital gains tax. Second thing, then what happens is, what is the status of unabsorbed losses? Carry forward of unabsorbed losses, that is also going to be unhindered because 72A also corresponding amendment is being proposed. ATWA is affordable housing project. 45 lakhs vareyulla housing projects. Only condition is the loan should have been sanctioned on or before 31/3/2021. That was the sunset clause. then 1,50,000 over and above section 24 deduction. Only condition 24 idum thammilulla vyathyasam 24 la aarde ennu borrow cheyyam specify cheyyaniല്ല. Ivide the loan should be from a financial institution nu specific aayittu parayunnundu. So only change now being made is the sunset clause 31/3/2021 la avasani ullil sanction, the loan should have been sanctioned by 31/3/2021 nu parayutta. That is now extended to 31/3/2022. Startup in the case of the startup 10 varshathile any 3 years you are eligible for 100% tax holiday. The startup should have been incorporated between 1/4/2016 and 31/3/2021 ആയിരുന്നു. Now ഇവിടെയും ഈ കൊറോണ കാരണം എല്ലാം അവതാളത്തിലായതുകൊണ്ട് the sunset clause is being extended by 1 more year. 31/3/2022 വരെ it is being extended. അതുപോലെ 54 GB എന്ന് പറഞ്ഞൊരു സെക്ഷൻ ഉണ്ട്. നമ്മൾ അധികാരം നമ്മൾ പ്രാക്ടീസിൽ യൂസ് ചെയ്യാറില്ല. 54 GB is like this: I transfer my residential house and I invest the net consideration in an eligible startup, and the startup in turn invest the money to in eligible assets. So മൂന്ന് phase ആണ്. What is transferred is residential house or plot of land. രണ്ടും അതിനകത്ത് പറയുന്നുണ്ട്. Residential property എന്ന് പറയുന്നത്, residential property is residential house or plot or both. രണ്ടും ട്രാൻസ്ഫർ ചെയ്ത് you are computing a capital gain. അവിടെ capital gain അല്ല ഇൻവെസ്റ്റ് ചെയ്യുന്നത്. The net consideration 54F മാതിരി തന്നെ net consideration is invested in an eligible startup, and the eligible startup should in turn invest this amount in specified assets. അങ്ങനെയാണെങ്കിൽ capital gains ലെ exemption ഉണ്ട്. And this exemption was available for transfers made up to 31/3/2021. 31/3/2021 വരെയുള്ള പ്രോപ്പർട്ടികളുടെ ട്രാൻസ്ഫറിനായിരുന്നു ഇത് ആപ്ലിക്കബിൾ. ഇവിടെ ഒരു സൺസെറ്റ് ക്ലോസ് ഉണ്ട് 31/3/2021. That 31/3/2021 is now extended to 31/3/2022. So that's only change as far as 54 GB is there. Anup sir പറഞ്ഞ 43 CA ആ കാര്യങ്ങളൊക്കെ we are coming on to it. ഇവിടെ കൊറോണ വന്നപ്പം ഏറ്റവും കൂടുതൽ ബാധിക്കപ്പെട്ട സെക്ടേഴ്സ്, one is travel and tourism, second is entertainment, third is real estate. ഈ മൂന്ന് മേഖലകൾ അവരുടെ അലൈഡ് ആയിട്ടുള്ള ആൾക്കാർ. So these three areas are badly affected. റിയൽ എസ്റ്റേറ്റ് OLX-ലും മറ്റുമൊക്കെ ഭയങ്കര വിലയ്ക്ക് കോട്ടിയുണ്ടെങ്കിലും no transaction is taking place. So builders are in debt. മൊറട്ടോറിയം എല്ലാം യൂസ് ചെയ്ത് കഴിഞ്ഞിട്ടും ഇൻട്രസ്റ്റ് ഇങ്ങനെ ബൗണ്ട് ചെയ്ത് വരുന്നു. At some point they have to liquidate. നമ്മൾ പത്രവാർത്തയൊക്കെ ഫോളോ ചെയ്തിട്ടുണ്ടെങ്കിൽ, കൊറോണ സമയത്തെ പത്രവാർത്തകൾ ഫോളോ ചെയ്തിട്ടുണ്ടെങ്കിൽ we know Piyush Goyal, Nitin Gadkari, all are exhorting the builders, you clear out your inventory. Don't expect the pre-corona price, but if you get something above cost, liquidate the stock and repay the loan. Don't carry on with the debt. So this is the advice they keep on giving. So angane varumbom there are instances where builders are compelled to sell the properties, their stock, below the stamp duty value. 43 CA at a 56 I'll come to it. 56/210 is income from other sources. ഇത് രണ്ടും ഗിവർ ടേക്കർ ആ ഇതാണ്. ഞാൻ ബിൽഡർ ആണെങ്കിൽ എനിക്ക് ആപ്ലിക്കബിൾ ആണ് പ്രൊവിഷൻ ആണ് 43 CA. എന്റെ കയ്യിൽ നിന്ന് വസ്തു മേടിക്കുന്ന ആൾക്ക് ആപ്ലിക്കബിൾ ആണ് പ്രൊവിഷൻ ആണ് 56/210. So builders are compelled to sell below the stamp duty value. 50C നമ്മളെല്ലാം ഫെമിലിയർ ആണ്. 50C comes under the computation of capital gains. 50C പോലെ തന്നെ അത്ര തന്നെ റെലവെന്റ് ആയിട്ട്.
Prashant sir, with due respect, can I just interrupt?
Yes, yes. Parnolu.
Sir, because not only from Kerala, some others from outside Kerala has also.
Okay, I'm repeating it in English also.
Oh, yes, yes, yes. Please, sir.
I'll
Thank
repeat
you, thank
what all I tell in Malayalam. I'll
Oh,
repeat
yes,
in
yes.
English also.
Okay.
So
okay,
for the
thank you.
ease of understanding of our members and to relate it, because afternoon time I don't since that's why I'm mixing both the languages. Anyway, I'll ensure that the members who don't know Malayalam also
So the
understand.
other members, I can just convey to the other members that you are just repeating the same in Malayalam and English also.
Yeah, sure. Okay. So coming to 43C, 43C applies to builder, whereas 56 to 10 applies to the buyer. Like we are familiar with section 50C, this 50C comes under capital gains computation, whereas these two comes under business computation and other sources computation. I'll give an example. Suppose I am a builder. I am having a property for sale. I hold it as my stock in trade. I offer it for sale for say 50 lakhs. 50 lakhs is my price. I have a buyer who buys it for 50 lakhs. Fine. 50 lakhs, my price, selling price, 50 lakhs, the buyer buys. Assume the stamp duty value is 40 lakhs. Assume stamp duty value is 40 lakhs. 50C we all know. If the stamp duty value is more than the actual sales consideration, and if the difference is more than 10%, then we have to adopt stamp duty value as the consideration. Same provision applicable in the case of 43CA. So 50 lakhs is the consideration, 60 lakhs is the stamp duty value, 50 lakhs into 10%, 55 lakhs, 60 lakhs is more than 10%, 110% of the cost. So 60 lakhs is adopted as consideration and business income is computed accordingly. Am I clear? And after that, what about the buyer? Buyer spends about 50 lakhs and he gets a property worth 60 lakhs. Here 56 to 10 is applicable. Now we have to see what is the difference. 60 lakhs minus 50 lakhs, it is 10 lakhs. First test is whether this is the difference is more than 10% of the consideration. Yes, it is more than 10% of the consideration. Fine. Then the second test, whether this is more than 50,000 rupees. Yes, it is more than 50,000 rupees. Then this 10 lakhs will be assessed as income from other sources in the hands of the buyer. So in the hands of the seller, the stamp duty value minus actual consideration is assessed as business income. In the hands of the buyer, the difference between stamp duty value and the actual consideration is treated as income from other sources. And if the buyer sells it again, then his cost of acquisition obviously will be 60 lakhs because he has paid for tax on the additional 10 lakhs. So his cost of acquisition, if in case he sells it in the future. Now, considering the pandemic situation, considering the recession, the builders are given some concessional treatment. They say, for a limited period, as a limited period offer, we permit you to sell with a margin, that margin of error, or they call it as, what is it called? They call it as safe harbor. The safe harbor limit for a limited period under 43CA will be 20% instead. Sell for 50 lakhs means it is acceptable. No income in the hands of the additional income in the hands of the seller. No additional income in the hands of the seller. What about the buyer? Buyer also same concession they are extending. In your case also, in the same situation, if they are buying from a builder, then you are also given the same concession. Instead of 10%, the safe harbor limit would be 20%. So buyer happy, seller happy. Now, what are the conditions? Let us see. Here is one situation where we have to read through the provisions. The existing provision I've explained, where the actual 43CA, first of all, let us consider, where the actual consideration, I'll call it as X, on transfer of land or building or both is less than the stamp duty value. Stamp duty value, we call it as Y. Then for computing business income, Y shall be the full value of consideration. That means stamp duty value, if it is more, you can take Y as the, and one safe harbor, what is the existing safe harbor limit? However, where Y does not exceed 110% of X, then for computing business income, X shall be deemed to be the full value of consideration. So 10% cushion is given. What is the budget proposal? Amendment is proposed to section 43A to boost the demand for real estate sector and to enable the real estate developers to liquidate their unsold inventory at a rate lower than stamp duty value. But here income tax no maatrame relaxation only. You have relaxation only for the purpose of income tax. Stamp duty issues la collector edulla endailum proceedings vannal, if any proceeding is being initiated by the collector of stamps, you have to face the song. There is no escape route there, but income tax purpose, you are getting a cushion. Amendment proposed to section 43CA to boost the demand in the real estate sector and to enable real estate that I've already read. It is proposed to increase the safe harbor threshold from existing 10% to 20% under section 43CA of the Act. The following conditions are satisfied. The transfer of residential unit to take place between 12/11/2020 and 30/6/2021. What is the significance of 12/11/2020? It's next to my birthday. The transfer to be by way of first time allotment of the reselling in Vetla. That's why I've told you 50C is kept outside the net. It's not applicable for reselling. This will be applicable only if the builder sells the property. It's a first time house allotment. The consideration in such case should not exceed 2 crores. That means affordable housing. That's what they have meant. In the case of premium buildings, premium land, premium plots, premium properties, this is not applicable. This is confined to affordable housing projects. What about the other side, the buyer side? That's what is explained here. Existing 56(2)(10), it provides that where any person receives in any previous year from any person or persons any immovable property for a consideration, say X, which is less than stamp duty value of the property, say Y, by an amount exceeding rupees 50,000. 50,000 is the benchmark threshold. Then Y minus X shall be taxed, charged to tax as income from other sources. Here also there is a safe harbor provision of 10%. Since builder is given the safe harbor of 20%, the corresponding buyer, if the buyer buys from a non-builder, if you buy from a person in a reselling of flat or a building, you are not eligible for this benefit. You are eligible for the higher safe harbor of 20% only if the property is bought from a buyer. And the period also 11/2020 to 30/6/2021. So up to June 2021, this offer is there. 50C, there is no change. Only 43CA and 56(2)(10), there is amendment. 50C is untouched. So for computing capital gains, the safe harbor continues to be at 10%. This was supposed to be one of the most popular measures in this budget. Senior citizens aged 75 years and above need not file income tax returns. So in the budget speech itself, I don't say finance minister took people for a ride. In the budget speech itself, finance minister said subject to TDS. Subject to TDS. So some people in a hurry, we say in Malayalam, like that, some people started imagining. We cannot blame the senior citizen because they in a corona pandemic period, they expected some relief or concession. It's quite natural on their part. Many senior citizens felt that they are, so if you are above 75 years and if you don't have business income, then you are spared from tax also. It is not like that. They have to bear the only concession being given to them is non-filing of return of income. But how far it is practically feasible, how far it is good for them, let us see. In fact, in one of my videos in Facebook, I've explained this provision in Malayalam. Most of you would have seen that, but well, let us see the provisions as it is being drafted. The senior citizen should be a resident senior citizen. If the provision, a concession is not available for non-residents, and it should be that the person should be of age 75 years or more during the previous year. And two types of income: pension income and interest income from the same bank in which he or she is receiving pension income. I've explained that video. If you are getting pension in State Bank, and if you are earning interest income in State Bank, in Canara Bank, in Catholic Syrian Bank, then you are out of the scheme. Suppose you have some dividend income, you're out of the scheme. Suppose you are earning a rental income, you're out of the scheme. You are eligible for the scheme only if you have pension income and interest income, which is credited in the same bank. Whether different branch also, I don't know. Same bank they have mentioned. I have my pension account in, say, you have a Pungunam branch of State Bank of India, and you have the interest, your fixed deposits, etc. in the Round branch. Then are you eligible for the scheme? Yes, because they have said in the same bank. They are not mentioned in the same branch of a bank. You are eligible. But if you have multiple bank accounts, fine, you are not eligible. Second thing, what they have mentioned is the bank shall be one notified by the central government for this purpose. You have to tell your clients, don't shift your deposits into one bank for taking this benefit. It is not advisable. From a risk management perspective, it is not at all advisable to move all the deposits into one bank. Though the DICGC provisions in the budget, some relaxations are made. 1 lakh is made, 5 lakhs last year. Now they have, for additional cover, some provision is being mentioned in the budget. I think that have been discussed in the macro analysis of the budget. Though such provisions are there, it is not advisable to put all the eggs in the same basket. Just to skip the provision of filing the return, don't advise the clients to put deposits in one bank. The bank shall be one notified by the central government. Though the law says you need not file return of income, you are asked to do cumbersome paperwork. The senior citizen is asked to do cumbersome paperwork. He shall furnish a declaration to the specified bank containing such particulars in such form and verified in such manner as may be prescribed. That is, no respite is there as far as paperwork is concerned. You have to do the same amount of paperwork. Instead of going to the bank, it is always advisable you come to the chartered accountant. Chartered accountant will be we are not charging any fees also. That's a fact that is accepted by the client as well as accepted by us. After the work is over, they ask what is the fees. We'll say nothing. They just smile and go. We take their blessings and file the return of income. In my case, 90% of such cases, above 75, 80, many cases are there with me. I file the return of income free of cost. It's a social service. We'll take it as a social service. We are even pleased to help that senior citizen lot in the future also. Once the declaration is furnished, it is as good as Form 16 filing. If the employer will collect all the details of the income of the employee and ultimately finalize what is the Form 16 figure to be deducted. Likewise, the bank has to do the same exercise. It has to collect the information about what is the pension income. It has to collect information about what is the interest income. It has to Chapter 6 deductions, that is, take evidences regarding Chapter 6 deductions. It has to consider rebates available under Section 87A. It has to compute tax under the normal provisions. It has to compute the tax under the 115 BAC provisions. All the exercises the bank has to do and ultimately arrive at what is the tax payable by the concerned resident senior citizen. And based on that, it has to deduct TDS and credit the balance amount to the account of the person. If all these conditions are satisfied, then the resident senior citizen need not file return of income. So it is nothing but a proclamation. That's all. Then one more important thing, assume if the senior citizen gives a false information. He omits to give particulars of a particular source of income, and later on silent about all this. So better if any senior citizen above 75 years asks you, you advise, or you explain to them these provisions and ultimately tell them it is always advisable you file the return of income and we are there to help you. Notified overseas retirement fund. This is something regarding the double taxation avoidance agreements. Basics of international taxation is that every country wants to tax its resident. Similarly, every country wants to tax the income whose source is situated in that country. Assume I am a non-resident. I work abroad. The country where I work, it wants to tax my income which accrues in that country because I am a resident in that country. Income earned by a resident, that country wants to tax it. Assume that amount is credited in India. India government wants to tax it because the amount is received in India. So source of income concept and residence concept. So this leads to a situation where the source country wants to tax as well as the resident country wants to tax the same income. Here what happens is, I worked abroad. Assume I worked abroad I worked in Saudi Arabia for say 20 years. After that, I have some smart retirement money lying there. What I do is, I encash this money and this money comes to India, and at that time, I am a resident in India. I encash this money. By the time money comes to India, I am a resident. So India government says on receipt basis, we tax it in India. They say on accrual basis, we tax it there. So all these confusions will come. Now government says, okay, we don't want to tax a money, especially the retirement money, when it is already taxed outside the country. So pala non-resident returnees, pravasigal tirichu varumbol, when they come back to the state, they will be encountering this issue. That's why I thought this particular program can be discussed in the platform. Government says we are studying that. We are going to come out with the rules regarding how to tax this particular issue, and we'll be notifying them soon. Dividend to business trust, see 194, if we analyze, it says a dividend to insurance company, etc. are not liable for TDS. Similarly, dividend to business trust, it is also provided in the negative list. That is, you need not deduct TDS when dividend is paid to a business trust. Okay, now coming to tax audit. See, if you ask me, is doing tax audit difficult or determining whether a person is liable for tax audit is difficult? Which one is difficult? I would say doing tax audit is much easier when compared to deciding whether a person is liable to tax audit, and if he is liable to tax audit, under which section he is liable for tax audit. Because 44AB says the limit continues to be at 1 crore. 44 AD says 1 crore to 2 crores if you offer an income of less than 8%, and if you have income more than the basic exemption, then you are liable for audit. Then 2 crores to 5 crores. If you are digital receipt, if you have receipts through banks, if you are payments through banks, and less than 5% is the cash expense or 5% is cash receipt, then also you are not liable for audit. Then comes 44 AF, regarding that transport operator, sorry, AE relating to transport operator. Then you have 44 ABA, ADA, that is something difficult, different professionals. I think that area alone has some degree of clarity, whereas 44 AB, 44 AD, and 44 AE are intertangled, so that it's difficult to determine whether a person is liable for tax audit. And if at all we determine that person is liable for tax audit, under which provision is liable for tax audit. So this is made as complicated as, or even worse than, rocket science. Last year, one amendment has come. If you're having a turnover up to 5 crores, if you're having a turnover up to 5 crores and 95% of your gross receipts, are through banking channels, and 95% of your expenses are through banking channels, then you need not get your accounts audited. Okay, 5 crores into 5%. 25 lakhs. 25 lakhs itself is a huge amount of cash expense or cash receipt as far as B2B suppliers are concerned. B2C, I will say, if you are a retail, if you are into retail, you cannot say 95% of my collections will be through bank. We are not grown up into such a digital economy. Nalla change, and there's a sea change. We have petrol pump clients where they used to have cash receipts of, say, I have a client who earns ₹1 million a day in cash. He used to get collection of ₹1 million a day in cash. Now the cash collection has come down to 1/10 or even 1/5. Why? Because most people are using the cards and wallets. Using card and wallet gives them many cashback offers. That is one incentive among the youth why they are using wallets and cards. So as a result, at one time they used to have daily cash balance of 10 lakhs. Now they are having daily cash balance of 1 lakh or 2 lakhs. Cash economy is coming down, agreed. But whether in retail, is it possible to achieve 5% cash payment ceiling? It's difficult. So I'm not talking about retail. I'm talking about B2B cases. B2B cases, the major expense is purchase, major revenue is sales, and invariably 100% of the sales will be through bank, because the customer, the buyer from you, will be facing 48(3) threats. So he will be buying using the banking channels. Your supplier, you pay using banking channels, because you are, the threat of 48(3) looms large on you also. So in such cases, if the turnover is 4.5 crores and assume that less than 5% is the cash receipts and cash expense, not required to get the accounts audited. Now, when the ceiling is enhanced to 10 crores, the amendment enhances the ceiling to 10 crores. Don't say it is not a matter of concern for us. It is a matter of concern, because you take 5% of 10 crores. It is not a small sum. It is 50 lakhs. It is 50 lakhs. A B2B supplier having a turnover of 10 crores, do you feel that his cash expense will be more than 50 lakhs? Do you feel his cash receipt will be more than 50 lakhs? So we are facing the fear of losing a tax audit. But filing of return is as important as tax audit. If you want to, though you are not filing to Form 3CD or 3CB, you are going to do the same service to the client. You have to tell him that 3CD is only a matter of certification. You are doing the same service to him. You have to, once scrutiny comes, be it tax audit or non-tax audit, all the aspects will be looked into by the assessing officer. So only difference is you are not having a 3CD. So you are looking into the same aspects of the accounts, and filing is return of income. So don't be scared. Tell the client, openly discuss with the client. Though there is a statutory requirement that you are not liable for filing the audit report, we are doing the same job. Second thing, do you feel banks will say we don't do the audit report? Banks invariably insist that if a client is having a turnover of, assume 10 crores, that gentleman will be having at least a loan of 5 to 10 crores. That business unit will be having an overdraft facility of at least 5 crores. Will banks give a loan of 5 crores without insisting that you give the balance sheet, audited balance sheet? So for the purpose of submitting to the banker, audit will be there. Though income tax says that audit is not required, 44AB audit is not required. It is required for other compliance purposes. GST audit is taken away. One day will come, even tax audit limit may go as high as 50 crores. The writing on the wall. Is it because the government lost faith in chartered accountants or not? I don't know. But government feels that everything is digitized. Payments are digitized, receipts are digitized, SFT has come in a big way. We are getting a lot of information from SFT. We are getting more information from SFT and other sources rather than from tax audit reports. Tax audit reports are giving us very little information. We are getting more information from SFT. We are getting more information from other revenue departments like stamp duty department, then from credit card departments. So all these departments are giving us lots of information. Then based on that, we are able to run the show. Even if tax audit is not there, the government is confident that we can run the show. It is obviously mentioned in some other provision, if I remember right, regarding reopening of assessment. In the memorandum explaining the finance bill, government has openly said that we have multiple sources of information. They have not mentioned the tax audit report at all. But one area they have mentioned, in the case of a 143(1)(a) adjustment, they have mentioned, because when there is a mismatch in what is shown in trial 3CD and what is shown in the computation statement, 143(1)(a) can be invoked. We'll come to it later. But coming to this tax audit, that in the coming years, don't expect any relaxation. The limit is going to go higher and higher. But whatever little tax audit we have, we should ensure that we do a good independent job on that. Last minute book I don't have an answer. You have to use your judgment, that's all. Advance tax installment for dividend income. See, we know immovable property transaction, we don't know when it will happen. 234C says that if you defer your advance tax installment, you have to pay interest. Capital gains is one unexpected income. So 234C itself provides that if you compensate in the remaining 2 or 3 installments which is there, then you need not pay 234C interest. Dividend income is also like that. You don't know how much dividend you are going to get, whether the company is going to pay you dividend or not. So you cannot anticipate dividend income beforehand and pay advance tax. So they have clarified that dividend income will also be treated at par with capital gains, etc. And 234C concession will be given if the shortfall is compensated in the subsequent, advance tax shortfall is compensated in the subsequent installments. This is regarding small charitable institutions. 1023C. First part is 3AD and 3AE. 3AD deals with universities and educational institutions. 3AE deals with hospitals. Not all 1023C institutions, only those covered under 1023C, 3AD and 3AE. 3 AD deals with universities and educational institutions, and 3 AE deals with hospitals and other healthcare institutions. For them, the present limit is 1 crore. If their gross receipts does not exceed 1 crore, they are given total exemption. And this is provided in Rule 2BC. 2BC that's not mentioned in the Act, that is mentioned in Rule 2BC. Now, Rule 2BC is proposed to be amended, wherein the limit of 1 lakh is going to be enhanced to 5 crores. 1 crore is going to be enhanced to 5 crores. See, regarding this is what Anup sir mentioned in the beginning. Why multiple due dates? Why there are messing up with the due date? First is the most interesting which struck to me. So it is like this. I am partner in a tax audit firm. The firm is liable for tax audit and I am a partner in that firm. So the due date for filing the return of income for the firm is 31st of October. So naturally, my due date is also 31st of October. Fine, there is no question about that. Now, suppose I am a person governed by the Portuguese Civil Code, where the income of spouses are shared and return is being filed. So my income will be known only when the accounts of the firm is finalized. So my spouse has to wait till 31st October, whereas her due date is otherwise 31st of July. Now, government felt, CBDT found out that she is very sad about this. Now, the government has proposed that in such a case, the due date for filing the return of income of the spouse will also be made in line with that of the other spouse. So it will also be made 31st of October. That is the first change. Next situation is, I am the partner of a firm which is liable for transfer pricing certification. If the firm is liable for transfer pricing certification, the due date for filing return of income is 30th of November. Now, since I am the partner of such a firm, my income could be computed only after the accounts of the firm are finalized. So I am also given the extended benefit. I am given the benefit of the extended due date up to 30th of November. Now comes belated returns and revised returns. Presently, belated returns and revised returns can be filed up to 31st March of the assessment year. Last year, last 2 years before, it was given, we were given 1 year from the end of the assessment year. So we altogether, we got 2 years for filing the belated returns as well as revised returns. And if you file the belated returns after the end of the assessment year, 271F penalty of 5,000 rupees was attracted. So that was that that we'll call a very comfort zone. I think up to assessment year 18-19, it was like that. That revised returns and belated returns could be filed within 1 year from the end of the assessment year or before the completion of assessment, whichever is earlier. And many people ask me whether processing of return under 143(1)(a) is completion of assessment. No. There are many decisions which have held that intimation under 143(1) is not an assessment order because the processing of return is not an assessment proceeding. Therefore, even if the return is processed, if time limit is there, you can file revised return. And we are filing revised return and CPC is accepting that also. So there is no issue as far as 143(1) processing is there. So presently we have time till 31st March for filing belated return as well as revised return. Last 2 years, what happened was we are asking for extension, government is not giving. So what is happening is many people are filing a provisional return. Within the due date, they file the provisional return with a view to revise it within 31st March. So you are getting extended due date just by filing a provisional estimated return. And sad thing is, The enthusiasm which people show in Twitter, etc., tagging finance minister, income tax department, etc., they use abusive language for not extending the due date. They use various troll pictures, etc., for abusing the department people and the finance minister. We should realize that in a social media platform, whatever we do is being observed by all. So this demeanor, even if done by a non-chartered accountant, it carries a picture as though these are being done by the chartered accountants. Second thing, even if it is done by the taxpayer, government feels that we are cheated. That maybe they say it is not the reason. They want to fast forward everything because everything is technology driven, everything is faceless, everything is rosy, everything is in place. They feel that we have to fast forward everything. As a result, we are reducing 3 months. We fix it as 31st of December of the assessment year. From next year onwards, 31st of December of the assessment year is the date for filing, revised return and belated return. And someone in a lighter vein said, if we fix 31st of December as the due date, you ask for extension, we'll give 1 month's extension. So even then it is 31st of January and we give time up to 31st of March, you still ask for extension, then we may be compelled to give 1 more month's extension. So it may go up to 31st of April, etc. So better we reduce the period and give you one extension. Like this corporate malls, etc., they sell 300 rupees cloth by putting an offer, buy one get two free, and they put the price as 900 rupees. Like that, the government has reduced the due date, and if you ask for extension, magnanimously they may grant 15 days or 20 days or 25 days, whatever it is. Government shows its goodwill. We are also happy we get 20 days extension. Ultimately, we lose another 10 plus 60, about 70 days we are losing. No worries, but we are getting extension now. We are happy. So it's a fact. We get our extension or not. It is a fact. It is an amendment proposed in the budget saying that the due date for filing belated return and revised return is preponed by 3 months. 31st December is going to be the due date for filing belated return and revised return. But one important thing, corresponding amendment is not made in 234F. From the due date till 31st December, the late fee is 5,000 rupees. And from 1st of January to 31st March, the late fee is 10,000 rupees. So the second limb of 234F gets naturally killed. So that is another impact of the particular amendment. What about defective return? Most of the conditions in section 139(1) treating a return as defective return relate to the period where we used to file paper returns. Still, those conditions are there in 139(9). And some conditions, the system automatically picks up and sends notices that your return is defective. And most common mistake is last minute, many people put some dummy challan number and upload the return. So when there is a challan number mismatch, the CPC throws out a defect memo. And once the defect is not cured, the return becomes an invalid return. If return becomes invalid, it means no return is filed, all the consequences follow. So government felt we have to give a relook under 139(9). So they empowered CBDT to relax wherever applicable the requirements under 139(9). So this is regarding filing of returns. Employees' contribution is always, it is there. It is a perennial headache throughout. We had the Markham case. Income Tax Appellate Tribunal held that employees' contribution to Provident Fund is allowable as deduction, provided you pay it within the due date for filing the return. 43B due dates will be applicable. Then Markham went to the Kerala High Court. Kerala High Court overruled the tribunal decision. And as the law stands, employer contribution is governed by 43B. Employees contribution is governed by 3615. So what happens is, if you fail to deposit employees contribution of PF, ESI, other welfare funds within the respective due date. So filling up of 3CD is very important. Filling up of 3CD, that per employee contribution. If you analyze form number 3CD, PF contribution, ESI contribution, they specifically ask only employees contribution. They are not asking about employers contribution. So employees contribution, most of us are using a particular private software, and that software always throws out the actual due date. And once we type the date of payment, we know if there is a delay, the software shows the date in red. And once a date is shown in red, that means in your computation, you have to disallow that. If you don't disallow, you file the 3CD and then file the return of income. If you don't disallow, take it from me in 143(1). The CPC will disallow that portion and complete the intimation. So that has been the scheme of things. But there are certain courts which held that the employee contribution should be treated at par with employer's contribution. And once employer's contribution and employee's contribution are deposited within the 43B due date, it is a valid compliance. So the entire amount should be allowed. And going to the basics, we will start from section 2, income definition, section 224. 224 says that amount collected from employees like this will be your income. Then you go to 3615A. 3615A says that if you deposit this money collected, it will be allowed as a deduction. And what is the due date? Due date under the respective act. Law is very clear. That is what the amendment also says. The law is very clear. We don't know why courts have held like that. Second thing is, collecting money from the employee is a fiduciary act by the employer. Employer collects the money from the employee. He cannot misappropriate that. He is bound to deposit it within the respective due date. If he is using it for his purposes, he is taking undue advantage, which should not be allowed. So citing these 2 points, it is proposed that clear mention will be made under 3615A as well as 43B. 3615A clearly says nothing contained under 43B is applicable for this provision. And in 43B, another amendment is made. Employees' contribution is not covered under 43B. So it is made amply clear, then the matter gets settled. Dispute resolution committee is the new mode of settling disputes. So what they are telling is, last year we introduced Vivad Se Vishwas. So as a result of Vivad Se Vishwas, you were given an opportunity to settle all pending disputes. All pending disputes are now settled and we are in a clean slate. And we don't want any dispute in future also. So we are introducing the scheme called Dispute Resolution Committee. Dispute Resolution Committee is nothing but a committee constituted by the government comprising of higher end income tax authorities. The central government is moving towards faceless proceedings, taxation and other laws, relaxation, amendment of certain provision. That Corona one ordinance. An ordinance came because during the time of pandemic, which got converted into a legislation, has empowered the central government to introduce similar schemes for other functions being performed by the income tax authorities. Vivad Se Vishwas scheme was launched last year to settle the pending disputes. While pending disputes are being resolved or adjudicated, it is important that in future there is less number of disputes from fresh assessments. Hence, in order to provide early tax certainty to small and medium taxpayers, very important, small and medium taxpayers, it is proposed to introduce a new scheme for preventing new disputes and settling the issue at the initial stage. In the Kuda Vaikimbo, settlement commission is no longer there. Settlement commission is killed. And government don't want high-end cases to be settled. They have made their intention very clear. At the same time, they don't want low income cases to continue also. So they want high income cases to continue, whereas they don't want the low income cases to continue. So for low income cases, what is low income cases? Income returned is up to rupees 50 lakhs. And the amount involved in dispute is less than 10 lakhs. In such cases, you can move to the dispute resolution committee. It will get resolved there. The biggest advantage is you will get immunity from penalty and prosecution. So like similar to settlement commission, a miniature settlement commission. So if you don't get Dulquer Salman, you make a picture using Tovino Thomas. That's the approach with which Income Tax Department is coming to the stakeholders. They say large cases, we don't want to get it settled. We want high-pitched assessments and the disputes to go on. In small cases, we don't have time to waste in small cases. You get approach us, we'll settle it. This is the scheme. The central government shall constitute one or more dispute resolution committees. The committee shall resolve disputes of such persons or class of persons which shall be specified by the board. SSC would have an option to opt for or not opt for dispute resolution through DRC. It's only optional. Only those disputes where a return of income is 50 lakhs or less and aggregate amount of variation proposed or in specified order is 10 lakhs rupees or less shall be eligible to be considered by DRC. If the specified order is based on search cases, they don't want to come under DRC, and invariably search, survey, requisition cases will be having huge impact. It will not be confined to 50 lakhs or 10 lakhs. So naturally, even if they don't specify, these cases will be having high tax effect. So they naturally won't come under DRC. SSC would not be eligible for benefit of this provision if there is detention, prosecution, or conviction under various laws as specified in the proposed section. Board is empowered to prescribe some other conditions in due course. DRC, subject to such conditions, shall have powers to reduce or waive penalty impossible under the Act or grant immunity from prosecution for any offense under the Act. Central government shall notify it on or before 31st March 2023. So 2023 is the cutoff date given for notifying dispute resolution committee. Then board for advance ruling. So we had an authority called Authority for Advance Ruling, which comprised of department officers and retired judges. So it was an independent body, not a wing of the department. Authority for Advance Ruling comprised of judges. That's what they are also highlighting. We are running short supply of judges. As a result, we are not able to constitute the authority. As a result, a lot of cases are being pending before the Authority for Advance Ruling. As a result, they want to rename it as Board for Advance Ruling. That's why someone in a lighter vein said, now AAR is going to become BAR, Board for Advance Ruling. Board for Advance Ruling, like in GST Advance Ruling Authority is Deputy Commissioner's Concilium. Like that, this Board for Advance Ruling is going to be a concilium of commissioners. 3 members who are commissioners. Based on them, their ruling, the things are going to work. But one important thing mentioned here is this particular order is appealable before the High Court. AAR orders were not appealable. AAR orders, assessee as well as department were bound to follow that. But BAR orders, only the department is bound to follow, whereas the assessee can prefer appeal before the High Court. This is one of the biggest amendments in this particular finance bill. Income escaping assessment and search assessment. Search assessment, the scheme of things, what they say is, earlier it was block assessment. From 2003 onwards, for 10 years, it was block assessment. Then they said, you take individual 6 assessment years plus running year and complete it as a single unit. That is a new method, 153A. That method has been invoked for quite some time. They say both the proceedings are not yielding any results. both the proceedings are not yielding any results. Now what they are doing is they keep on filling the wine in new bottles. One bottle not perfect, the second bottle also not perfect. Now they are filling it in the third bottle. They say, in earlier years, if I remember right, when my father were practicing, it was like this. It is assessed as under 148 itself. And as a regular assessment, the such cases were assessed under 148. The same old scheme of things have come to place. Such assessments will now be handled under section 148. 153A to 153C, that proceeding is gone. All pending cases will be completed there, but new cases, searches from 1/4/2021 will be handled, will be dealt with under the provisions of 148. That's a major change. Let us read through the provisions. That's why I told this provision could be better understood once we read through the provisions. Section 147 is the base for reopening. Though we call it as reassessment, it is not confined to reassessment. An income can be first time assessed under 147. 143, one processing will be there. After that, a case may be first assessed. 143(2) due date would have been over. And after that, say within 4 years or 6 years, the return may be first time assessed under 147. So 147, there can be assessment, there can be reassessment, there can be recomputation. So you have assessment, reassessment, as well as recomputation. So all the three, for analytical sake, we call them as reopening. Let us call it as reopening. Reopening is permissible only if the AO has reason to believe that income chargeable to tax has escaped assessment for any assessment year. He has to issue notice under 148. So 147, first starting point is reason to believe that income has escaped assessment. Then he has to issue notice under 148. Notice under 148 can be issued adhering to the timelines prescribed under section 149. So it is 147 read with 148, read with 149. So once it is initiated, you cannot complete the assessment under 147. You have to go back to 143(2), 142(1) notice and complete the assessment under 143(3). So this is the game of 147. Presently, department has a lot of information. That is what I was telling. What are the sources of information they are mentioning here? Presently, department has a lot of information, especially from SFT reports under 285BA and information from other enforcement agencies. This information is also shared with taxpayers because presently 26AS is like a newspaper. Once you open 26AS, you will get the TDS information, you will get the TCS information, you will get the advanced tax information, you will get the GST information, you will get the amount of cash deposited into bank and whatnot. You have a lot of information being shared in form number 26AS. Department nowhere here mentioned that what we get from the audit reports. They are not mentioned anything like this. Department uses this information to verify the information declared by a taxpayer in their return and to detect non-filers and those who have not disclosed the correct amount of total income. Therefore, assessment or reassessment or recomputation of income escaping assessment to a large extent is information driven. In view of the above, there is a need to completely reform the system of assessment or reassessment or recomputation of income escaping assessment. The salient features of the new procedure are as under. Section 147 proposes to allow the assessing officer to assess, reassess, or recompute any income escaping assessment for any assessment year called relevant assessment year. Before such assessment or reassessment or recomputation, a notice is required to be issued under section 148 of the Act, which can be issued only when there is information with the assessing officer. Earlier it was reason to believe. Assessing officer has reason to believe means he can issue 148 notice. Now it is not possible. It is the new provision says when there is information with the assessing officer which suggests that income chargeable to tax has escaped assessment in the case of the assessee for the relevant assessment year. Prior approval of specified authority is also required to be obtained before issuance of such notice by the assessing officer. Specified authority means principal commissioner, principal director, commissioner or director if 3 years or less than 3 years have elapsed from the end of the relevant assessment year. So if it is up to 3 years, approval from principal commissioner, principal director, commissioner or director. If it is more than that, principal chief commissioner, principal director general, or where there is no principal chief commissioner or principal director general, chief commissioner or director general, if more than 3 years have elapsed from the end of the relevant assessment year. So reopening is possible even beyond 3 years. Earlier it was 4 years, additional 2 years with permission, then 10 years when there is undisclosed income. So that is a scheme of things as of now. 4 years normal, 4 to 6 years, that additional 2 years with special approvals, beyond 6 years up to 10 years when there is a significant undisclosed income. It is proposed to provide that any information which has been flagged, that means system terminology, the department is getting a lot of information, they have said, this will be subject to a data analytics project, software of the department, and based on that data analytics of that present CAS selection, we call it, the computer aid assisted scrutiny system. This is a data analytic mechanism. The computer assisted CAS mechanism is a data analytics device. Based on that, the CAS software will flag certain transactions. Based on that, cases are selected for scrutiny. Likewise, the same analogy, the same principle is being used here. What they are telling is, it is proposed to provide that any information which has been flagged in the case of SSC for the relevant assessment year, in accordance with the risk management strategy formulated by the board, shall be considered as information which suggests that the income chargeable to tax has escaped assessment. Flagging would largely be done by the computer-based system. So in the law itself, they have said, that's very crucial. Normally, SSC asks for reason and they give the reason. Based on that, SSC will challenge, SSC will go on it. All these are put to rest. Now they say computer can select a case for reopening. Further, final audit objection raised by controller and auditor general. Many court decisions are there. Audit objection cannot form a basis for reopening a completed assessment. Now that is also put to rest. Earlier there was an in principle departmental circular which said a final audit report can be a basis for reopening. Now they have put it in the statute book. A final objection raised by Comptroller and Auditor General of India to the effect that the assessment in the case of SSC for the relevant assessment year has not been in accordance with the provisions of the Act shall also be considered as an information which suggests that income chargeable to tax has escaped assessment. But one thing, normally they will send you a notice. In your case, we have reason to believe that income has escaped assessment. They will not communicate to you the reason. At that time, the decision which we followed as sacrosanct as Ramayana or Bible or Bhagavad Gita, whatever it is, was GK and Driveshaft decision of the Supreme Court. GK and Driveshaft case prescribed the procedure to be followed in the case of reopening of assessment. First step, it says, once you receive a notice under 148, you write to the assessing officer asking the reason for reopening. Once the assessing officer gives the reason, you have to raise your written, you have to give a written objection for the reasons for the reopening. Based on that, the assessing officer has to dispose the objections with a speaking order. It seldom happens, but the assessing officer has to dispose of the objections with a speaking order. Then only he can proceed to assess the case. Now, GK and Driveshaft case has got recognition in the statute book. A new section 148A is being introduced. New section 148A of the Act proposes that before issuance of notice, the assessing officer shall conduct enquiries if required and provide an opportunity of being heard to the assessee. After considering his replies, the assessing officer shall decide by passing an order whether it is a fit case for issue of notice under section 148 and serve a copy of such order along with such notice on the assessee. The assessing officer shall, before conducting such enquiries or providing opportunity to the assessee or passing such order obtain the approval of the specified authority. However, this procedure of inquiry or providing opportunity and passing order before issuing notice under 148 shall not be applicable in search or requisition cases. Obviously, search or requisition case, the department has found out certain information and assessee is supposed to be viewed with a prejudice. In that case, obviously, there is no need for such a proceeding. The time limitation for issuance of notice under 148, presently I told 4 years, additional 2 years, up to 10 years. That has been reduced. Time limitation for issuance of notice under 148 of the Act is proposed to be provided in section 149 of the Act and is as below. In normal cases, no notice shall be issued if 3 years have elapsed. 6 years now is reduced to 3 years. 3 years have elapsed from the end of the relevant assessment year. Notice beyond the period of 3 years from the end of the relevant assessment year can be taken only in very few specific cases. In specific cases where the assessing officer has in possession evidence which reveal that income escaping assessment represented in the form of asset amounts or is likely to amount 50 lakhs or more. So go beyond 3 years means 50 lakhs or more in the evasion undavanam. So there should be an evasion of at least 50 lakhs of rupees. Another restriction has been provided, cannot be issued. Another has been provided that a notice under 148 of the Act cannot be issued any time in a case for the relevant assessment year beginning on or before first day of April 2021. That means old cases. In the case of old cases up to 1/4/2021, the old provisions will be applicable. Under the new provision, even if time limit has not expired, you cannot issue notice under section 148 in the case of old cases. Once assessment or reassessment or recomputation has started, that is presently also it is there. Once it is started, any new information which comes to the assessing officer, he can use them for the purpose of doing the assessment. Now, search cases. What is so special about search cases? Search cases, I have told that the earlier systems failed. And as a result, the search assessments are also brought under the purview of 148. In view of the above, there is need to completely reform the system of assessment of search-related cases. The salient features of the new procedures are as under. Provisions of section 153A and 153C of the Act are proposed to be made applicable only to search initiated under section 132 of the Act, or books of accounts or other documents or any assets requisitioned under section 132(2)A Act of the Act on or before 31st March 2021. So for search conducted after 31/3/2021, the new provision under section 148 will be applicable. Further, in search, survey or requisition, very important. Survey nowhere else survey was mentioned. In search, survey or requisition cases initiated or made or conducted on or after 1/4/2021, it shall be deemed that the assessing officer has information which suggests that income chargeable to tax has escaped assessment in the case of assessee for the 3 assessment years immediately preceding the assessment year relevant to the previous year, in which search is initiated or requisition is made or material is seized or requisitioned or survey is conducted. That means presently survey cases, the current assessment is completed. Now it is not like that. Compulsorily 3 years are to be reopened, even in the case of survey. Since assessment or reassessment or recomputation in search or requisition cases, which are conducted prior to 31st March 2021, then the old sections 153A to 153D will be applicable. 142(1), it's an enabling amendment. See, 142(1) is enquiry before assessment, enquiry for the purpose of assessment. And one power of assessing officer under 142(1) is ask the assessee to file return of income. Assessing officer under 142(1) has got power to ask the assessee to furnish return of income. Now everything is jurisdictionless, everything is centralized, everything is faceless. Now, who sends the notice? the communication channel between the SSC and the department is the National E-Assessment Center. They send the notices. And most of us are familiar with one name, Praveen Agarwal, who digitally certifies all the notices, etc., which we receive. So National E-Assessment Center sends the notice. Whether National E-Assessment Center is eligible to issue 142(1) notice. Technically speaking, no. Only the assessing officer, the jurisdictional assessing officer, is bound to issue 142(1) notice. This anomaly is addressed on a prospective basis. They say from next year onwards, the person authorized, the officer authorized by the government is eligible to send 142(1) notices. Income Tax Appellate Tribunal is also going to be faceless. So first E-assessment was made, then E-assessment was made faceless assessment, then faceless assessment was followed by faceless appeals. First appeal, CIT appeals now became faceless, and last 2 weeks back, the penalty proceedings are also now in the faceless mode. So we have faceless assessment, we have faceless penalties, we have faceless appeals. So continuation of faceless appeals. The second appeal, that this tribunal is also going to be made faceless, subject to 3 conditions. They say to the extent technically feasible, they are going to make it faceless, and they envisage that it will reduce cost of complaints to the taxpayers. It will increase transparency in disposal of appeals, and last thing is very important, it will help in even out the work distribution in different benches, resulting in best utilization of result. If you see Cochin bench, the work position is, the work pressure is less. If you see Bombay, there will be a lot of pending cases. That's how they can balance the work distribution. Therefore, it is proposed to insert new subsection, eliminating the interface between ITAT and parties to the appeal in the course of proceeding to the extent technologically feasible. Optimizing utilization of resources through economies of scale and functional specialization, introducing an appellate system with dynamic jurisdiction. That means a person sitting in Delhi can adjudicate a case which is being filed from Trichy. So this is the scheme of things, but transition won't be as easy. Transition won't be as easy because the major players in the tribunal are not chartered accountants. Major players in the tribunal are advocates. That's a fun thing. Advocates are more powerful than us. Advocates have more acceptance in the courts than chartered accountants. And apart from that, when we fight it on merits, tribunal don't undermine. This is a judicial forum. Tribunal is a judicial forum, which is the final fact-finding authority. Being a final fact-finding authority, it has to analyze, it has to apprise, it has to see various evidences, which technically in the faceless mode is very difficult. As rightly said, papers don't speak for themselves. It is obvious that these evidences are presented before the judges and the evidences are explained and articulated. Moreover, how far the faceless mode gives us opportunity for cross verification, cross objections, and if once a person gives a statement, we have to cross examine the other person. How far it is possible in the electronic platform, we don't know. Anyway, government is not going to rush through because the amendment proposal itself says you are given time till 31/3/2023 to notify the provisions. Discontinuance of Income Tax Settlement Commission. This is the surprise package. Once it happened, when UPA was ruling and a person of the opposition party, a celebrity from Tamil Nadu, whose case was pending in the settlement commission, and her arch rival, another finance minister from Tamil Nadu, was the person from Tamil Nadu was the finance minister. Their egos locked horns, and he introduced a provision to abolish settlement commission. 3 years later, his successor in office reintroduced settlement commission. Now, settlement commission is again killed. This is one amendment. This is the only amendment where the government has not mentioned the reason why this amendment is brought about. All other amendments, it's done by a reason. All the amendments, all the proposals are made with a reason, but this amendment is carried out without any reason. That means there is surely some political vendetta behind it. And to people's surprise, the amendment says from today, Settlement Commission is going to be wound up. From the budget day, 1st of February, Settlement Commission is going to be closed. And all pending applications will be adjudicated by a body called, board for settlement. So they'll constitute a board for settlement for adjudicating the pending cases. But legally, is it correct? That's the issue. They say from 1st of February, it is not going to work. And at this point, the finance bill is at the bill stage. It is not a statute. Based on a piece of paper, which is not a statute, can the functioning of a body which is constituted under Act can be ceased or stopped? Is it possible? It's a question of law, which most people are going to take up with the high courts, and high courts are sure to pass their orders on this. The reason is these 2 months, February, March, is the peak time where people rush to Settlement Commission because the assessment will be going on. And they feel in assessment, they are not going to get justice. They feel we settle the matter and we escape penalty prosecution, etc. So this is the time people move to Settlement Commission. Moreover, the department officers themselves advise the clients, we will not get justice because we have limitations in our power. We cannot allow certain 48(3) deduction, etc., etc. We cannot allow expenditure in respect of undisclosed income. Settlement Commission has got power. So you go to Settlement Commission. Officers themselves, we have come across cases where officers themselves have referred cases to the Settlement Commission. In good spirit, they have advised the assessee, you go to the Settlement Commission and get a better deal. So facts being so, there are assessees who have paid some amount of tax in anticipation of going to Settlement Commission. There are chartered accountants who have prepared an application, and the only thing remained was signing the application and sending it through registered post. So like we at various stages, various levels, applications pending, taxes paid, intentional, whether people are thinking about moving to the Settlement Commission, all in place. One fine morning, Finance Minister announced that Settlement Commission is going to be closed down. And what I'm made to understand is the officers also by afternoon got a fax message. You close down and leave the space. You wait until further orders are received for your new posting. That means officers are also removed. Settlement Commission is now Talaband. It is made like this. Why? No mention. And lots of subsection where reference is there to Settlement Commission. Consequential amendments are also proposed. Reduction of time limit for completion of assessment. As we know, section 153 prescribes the time limit for completion of assessment. Under two areas, time limit for completion is reduced. 143(1), processing of return. 1 year from the end of the year in which return is filed was given. 1 year from the end of the year in which return is filed. Time till that period was given. If assessment year is 2019-20, I filed the return on 31/3/20, then CPC would get time till 31/3/2021 to process my return. That is being changed. That is made 9 months. So processing of return by CPC, 9 months from the end of the month, end of the year in which return is filed. Similar amendment is made for completing the assessment. If we see, earlier it was 24 months from the end of the assessment year, 18 months, then 12 months, 18 months. Because of Corona, we got extension till 31st March, then 12 months. Now the 12 months is now reduced to 9 months. You have to complete the assessing officer or the National E-Assessment Center in coordination with the other wings. They have to complete the assessment within 9 months from the end of the assessment year. for all practical purpose from the end of the assessment year. If the assessment year is 2021, if assessment is 21-22, from 31-3-22, 9 months means 31-12-2022, the assessment should be completed. What about sending notices under 143(2)? Earlier it was 6 months from the end of the year in which return is filed. If the end of the assessment year is 31-3 means by 30th September, 143(2) notice should be sent, and based on that assessment has to be conducted. Now that time frame is also reduced. It is made 3 months from the end of the assessment year. But one thing is there, belated return time limit is 31-12. 31-12 to 31-3, 3 months you get. Another 3 months from 31st March to 30th June. So practically for sending 143(2) notice, 6 months is there, but it is spread over 2 different assessment years. Now coming to charitable institutions, 3 aspects are dealt with here. One is corpus donation. Second is application from loan. Third item is set off of losses. 3 items. One is corpus donation. Second one is application of money from loaned funds. Third one is loss computed and it's set off. These 3 are the important aspects dealt with in this amendment. Before that, let me explain how corpus donation is being dealt with. Corpus donation is the donation received by a trust with a direction that it shall form part of the corpus of the institution. Shall form part of the corpus of the institution. Under section 11(1)(d) and corresponding section under 1023(c), it is not treated as income. That means if my total receipts is 12 lakhs or 12 crores, and out of that 2 crores is corpus donation, then 10 crore minus 2 crore, that is 12 crore minus 2 crore, 10 crores. I have to utilize only 85% of 10 crores. Or I can accumulate 15% of 10 crores. What people used to do is, they do that computation perfectly. 12 crores is my total receipt. 10 crores is my income after corpus donation. I use 85%. But in this 85%, I claim amount utilized from corpus donation also. So what the government now says is, you claim this 2 crores as not income, and you claim this amount utilized as application of income. So that means you are getting double benefit. You are reducing it from income and you are adding it to the expenditure. So we are at loss. Now what we say is, you can reduce it from income, fine. You reduce. You spend it, fine, you spend it, no problem. But one thing, if you spend it from the total expenditure, you reduce that. That means expenditure out of corpus donation will not be allowed as application of income. Now what is the remedy? If you want to claim it, then do one thing. You replace that corpus donation, you invest that money in 11(5) funds. 11(5) permissible modes, you invest that money in modes permissible under 11(5). So 2 things, corpus donation, invest in 11(5) modes, or apply but don't claim in computation as expenditure. If you claim it, and if you want to claim it as a deduction, then equivalent amount you transfer to 11(5) investment. So this is the tax treatment regarding corpus donation. Second thing, you apply from loaned funds, borrowed money. Can you claim it as application of income? No. Section 11(1) itself says amount of income applied for charitable purposes. Amount of income applied for charitable purposes eligible for claim. Whether loan applied is income applied? No. So what you have to do is, the amount spent out of loan shall be deducted from the total application. Then what is the remedy? When you repay the loan, claim it. When you repay the amount from your income, you can claim it as an application of income. That also is now, earlier there were case laws, now that is brought into the statute book. So two things, corpus donation. Last year there was an amendment regarding corpus donation. They said, when you give corpus donation to another trust, it will be treated as exempt income in the hands of the recipient. But for you, it will not be allowed as deduction. So X trust and Y trust are there. X trust gives corpus donation to Y trust means in the hands of Y, it is not taxable, but in the hands of X, it will not be allowed as application. The same analogy is extended. If you apply from corpus donations, it will not be allowed as application of income. If you want to claim it, then replace whatever has been applied, you deposit in bank, you can claim it. Then what about loan? Amount spent from loan is not allowed as deduction. If you repay the loan, then claim it, fine. And what about loss? Government says that you compute loss. Why? Because you apply from corpus donation, you apply using loan, and these amounts you claim is as application. Once you stop doing this, you will end up with no profit, no loss situation. You will not compute a loss if you don't claim borrowed money spent, if you don't claim corpus donation spent. And if at all you have a loss, government says you cannot reduce it from your income. You cannot reduce it from your income. Brought forward losses cannot be adjusted against your income to be applied. Whether it can be added to the application, there is no provision under the Act which enables adding the previous year's loss to your current year application. The only enabling provision which people used to hang on was reducing the brought forward loss from your income to be applied. Now that area is also plugged. It says that brought forward losses, etc., deficit, etc., you cannot set off against your income. Whether it is added to, whether it can be added to the application of income, that is totally ruled out, because there is nowhere in the Act there is an enabling provision to add it to the application of income. So these three are the major changes as far as trusts are concerned. I have elaborated it, so you can just go through it. ULIP policy and provident fund, these two amendments, I'll take it together. Last year, what the government did was, they said dividends are taxable, mutual fund incomes are taxable. So these were the amendments last year. Now, another two exempted income sources, they say these are also going to be made taxable. So the intention of the government is very clear. We want to give you very limited exempted income. We want your investment income to be taxable. Why? Government feels we have to move towards an expenditure-driven economy rather than a savings-driven economy. All governments, I'm not taking any sides. The government which ruled us 10 years ago, government which is ruling now, all are from financial perspective, they are alike. What they want is they have to show a high growth rate. How a high growth rate can be shown? High growth rate can be shown when there is high spending. How there can be high spending? When there is a reduction in interest on borrowings, and when there is a reduction in interest on savings, people tend to invest. People tend to spend. I deposit money in SB account. Earlier, I used to get as high as 5%. Now I get 2.5%. My case, it's okay. Assume I'm an 80-year-old. I get a bank interest from FD as low as 5.25%. My hard-earned money. I'm not a pensioner, assume. I may have to depend on my children. I may have to show my hands to children for money. I may have to beg to them. So government is least bothered about it. They want to say if people tend to save more and more, the money supply in the market will be affected. As a result, the growth cannot be a better 5 trillion, whatever it is, it cannot be achieved. The projected economic growth cannot be achieved. Many people have lauded the investment in infrastructure. Why infrastructure investment? If you read it together, the automobile scrapping policy also you read. That means old cars gone, invest in new car. When new car comes, more road is required. It's a circular function. More car means more tax means more money is spent on roads. Again, public investment is there. So altogether, government wants to show a buoyancy in the economy. And if I say I am offering you 10% or 8% return on your deposit, I'm very sure 8% rate on deposit, if you offer, I'm very sure 20 to 30% of the spending will come down. Oh, I'm getting 10%, 20%, and cumulatively I may be getting an yield of 12 to 13%. Fine, I'll save my money for a while. So people deposit it into the banks, etc. So banks will be flushing with money. Now what they have to do is they have to lend. Lending means more bad loans. So it's going to be a vicious circle. I don't know if we have grown up to a stage, we are developed, our economy is developed to such a stage where we can disincentivize savings. I don't know. Or is Indian economy grown up to that particular level where we say no longer savings, you spend? It will be good if government meets our social security needs. And coming to our presentation, it says the ULIP policies with premium more than 2.5 lakhs. ULIP policies with premium more than 2.5 lakhs issued after first day of February 2021. Old policies they are spared. New policies with premium of 2.5 lakhs on maturity, on premature withdrawal, you will not get 1010D exemption. And one important welcome clarification they have made is it will be treated as a capital asset and computation will be done as though it is a capital gain. They did not say whatever surplus you get, offer as income from other sources. One welcome clarification they have mentioned is you treat it as a capital asset, compute capital gains accordingly, because this particular transaction is going to suffer securities transaction tax. So the computation will be same at par with the equity shares computation. How equity shares capital gains computation is going to be done with all grandfathering, etc. That same manner, the computation of income from ULIP policies are to be done. Slump sale, it is an interpretational issue. Definition of slump sale, if you see, it is a transaction of sale where individual values of assets are not described. That is the definition. So many people started to interpret that if it is a sale, it is a slump sale. Capital gains will be attracted. If it is by way of exchange, relinquishment, extinguishment, etc., there is no capital gains. Because transfer definition not only includes sale, exchange, relinquishment, extinguishment, etc., come under the definition of transfer under section 247. But people hanged on to the definition of slump sale. They say slump sale will become liable for capital gains tax only if there is sale. If I exchange undertakings, then there will not be any taxability. And some tribunals or courts started accepting this. Then government has brought about this clarificatory amendment, says any mode of transfer, if slump sale is executed by any mode of transfer, it will be liable for capital gains tax. This is regarding the retirement of partner, how it has to be dealt with. Now, present scenario, what we advise our clients is before retirement, you value your goodwill, you revalue the assets and show a huge capital balance in the account of the outgoing partner. And once huge capital balance is given, hence his accounts is settled, the firm will not be liable for capital gains tax. At the same time, partner will get a substantial nice sum when he retires. Now, government says enough is enough. We are going to amend this provision. They say when partner retires, and he gets any capital asset representing his capital account balance in the books of the firm, then consideration will be fair market value of such capital asset on the date of such receipt, and cost of acquisition will be cost of acquisition of the asset which is being given to him. This is a plain case where a partner retires and one of the capital assets of the firm is given to the partner. Second scenario is a partner retires and he's given money and some other assets. Here computation is a bit different. What is the consideration? Consideration is money plus fair market value of the asset which is given. What is the cost? Cost is the balance in the capital account of the partner. Balance in the capital account of the partner will be treated as cost. And what is balance in the capital account of the partner? Balance in the capital of the account of the partner will be balance as it stands now minus additions on account of valuation of goodwill or any other self-generated asset. That means you value some self-generated asset and credit the corresponding amount to the partner's account. Similarly, if you revalue the assets and credit that amount, these all are to be excluded. That means firm will be liable for capital gains in the case of such arrangements. If you want to give a higher sum to the partner continues to be tax-free. The partner need not pay any tax. The outgoing partner need not pay any tax, but the firm has to pay tax because the capital account of the partner is considered as the cost, and the cost has to be computed without giving regard to valuation of goodwill or valuation of, increase on account of any revaluation of assets. Fake invoice items, last year a penalty provision has come, 271 AD. If someone connives for falsification of books, fake invoices, etc., you will be liable for a penalty. And sad to say, wherever GST fake invoice cases are caught, at least one member of our profession is there. This is also one reason why government thought GST audit is no longer required. And second thing, once that amendment has come, we chartered accountants presently have no role in GST. Why? Because some black sheeps in our profession connived with certain unscrupulous persons and did some misdeeds. As a result, the entire image of the entire profession got tarnished. So similar provision, once there is, if something is detected under GST, there is exchange of information, it will come to the income tax department. Income tax department also has the power to levy penalty under 271 AD. And pending the penalty proceedings, they are given power to provisionally attach immovable properties of the persons Depreciation on goodwill. This is a settled law. Supreme Court in Smith Securities held that goodwill of business is an intangible asset. Goodwill of business is an intangible asset which is eligible for depreciation. Whether self-acquired goodwill, no, self-acquired goodwill does not have any cost. Acquired goodwill, purchased goodwill, it is eligible for depreciation. But department is unhappy with that. Department says, Supreme Court, though it is said like that, the issue is depreciation, goodwill of a firm never depreciates. As it carries on business, the goodwill keeps on appreciating. So goodwill is not something which we can say it is a depreciable asset. So government politely disagrees with the Supreme Court and introduces this amendment stating that goodwill will not form part of the definition of intangible asset, and goodwill is not eligible for depreciation. So consequential amendment is given in section 55 for the purpose of computing capital gains also. (143.1) I have already explained, and 143.2 notice, these two we have mentioned. Processing of return has to complete by 9 months from the end of the year in which return is filed, and 143.2 notice, the time limit is 3 months from the end of the year in which return is filed. 44 ADA, there was a hue and cry why LLPs are not covered. Government has clarified that why LLPs are not covered under 44 ADA. Says under the LLP law, you are bound to maintain books of accounts. So we cannot give you a provision which overrides the governing law. So it is clarified that LLPs are not eligible for taking the benefit under section 44 ADA. Vivad se Vishwas, one clarification has come. Order of Settlement Commission is not eligible for Vivad se Vishwas. Income tax disclosure scheme, IDS scheme was there after demonetization. The scheme certain people made a declaration but failed to pay full tax. Whether in such cases refund is eligible. Government said refund we can give. Now they have clarified that we can give refund but will not give any interest. TDS on purchase of goods. This is one important amendment. We'll just read through it. Chapter 17B of the Act relates to deduction of tax at source. The provisions of this chapter provides for TDS on various payments at the rates contained therein. It is proposed to provide for TDS by person responsible for paying any sum to a resident for purchase of goods. Last year, sale of goods was brought within the purview of TCS. This year, purchase of goods is being brought within the purview of TDS. The rate of TDS is kept at very low rate of 0.1%. It is proposed that tax is only required to be deducted by those persons with whose total sales, gross receipts or turnover from business carried on by him exceed 10 crore rupees during the financial year immediately preceding the financial. Same condition in 206A last year what has been brought. The corollary conditions are mentioned here. 10 crores rupees turnover. Central government is proposed to issue notification enabling this. Tax is required to be deducted by such person if the purchase of goods from him, from the seller, is of the value, aggregate of value exceeding 50 lakhs of rupees in the previous year. So we have to advise the clients. Those suppliers where payment in a year, first of all, the threshold we have to see. Last year, what was the turnover? If it is more than 10 crores, this provision is likely to be applicable. Once this is likely to be applicable, where tax has to be deducted? Where tax has to be deducted when the purchase payment towards purchase exceeds rupees 50 lakhs. It is also proposed to provide that provisions of this section shall not apply to a transaction on which tax is deductible under any other provisions of the Act, transaction on which tax is collectible under the provisions of section 206C, other than transaction 2 is subsection 1H. Subsection 1H is dealing with sale of goods. I'll explain it like this. I am the seller and Ajit is the buyer. And my sale to him is 1 crore rupees. I invoice, and for section 206C, 1H says that at the time of receipt of money, tax has to be collected. But people don't wait till the receipt. What people commonly are doing is, along with the invoice, they raise TCS bill also and debit the account of the party. So at the time of accrual itself, they are collecting TCS. Software is also programmed like this. Now, what I do is I raise a bill on him for 10 crores rupees, 1 crore rupees, along with TCS. So TCS suffered transaction. Can he say that when he makes the payment, he will not deduct TDS? He cannot do, because 206C 1H is excluded. So even if TCS is done under that section, the buyer has to deduct TDS. But think otherwise. Ajit and myself make an understanding. We will make an arrangement. I say, you deduct TDS. I will not deduct TCS. Is it possible? If we read 206C1H, there it says, if the transaction is subject to TDS, there is no exclusion of the new section. If the transaction is subject to TDS, then TCS need not be made. So we have to rethink the contracts. We have to adjust. We have to advise the client to change the softwares so that the transaction suffers TDS. Once it suffers TDS, the seller need not do TCS. But if the seller does TCS, it is not an excuse for the buyer not to deduct TDS. So seller deducts TCS first means buyer should also deduct TDS. So TDS, TCS, both will happen. Suppose buyer says I will deduct TDS, then seller need not collect TCS. So there is subtle difference the way we draft the agreements. This here also it is clarified that if that means in a transaction, a TDS or TCS collection also is required to be carried out under the other provisions. Okay. There is one exception to this general rule. If on a transaction, TCS is required under subsection 1H of section 206C, as well as TDS under this section, this is this one, where I point out the arrow, This is one exception to this general rule. If on transaction TCS is required under subsection 1H of section 206C as well as TDS under this section, then on that transaction only TDS under this section shall be carried out. But if TDS is not done, the other party will be liable to collect TCS. Board is given power. And if there is no PAN, the other section 206AA has to also be read in tandem. Last year, 194N to start with, they said if the counterparty is not a filer of regular filer of return, TDS has to be done at a higher rate. If the counterpart, if the banks are liable to deduct TDS, and if the customer is a non-filer, TDS has to be done at a higher rate. The same analogy is now extended to other transactions regarding TDS. It says, if you deduct TDS, etc., fine. You have to ensure that the other party is a regular filer or a non-filer. TCS also same thing is being introduced. How we can find out whether the other party is a non-filer or a filer? The last line, 194N, regarding the cash withdrawal TDS, there is a link provided by the Income Tax Department, which helps us to see if the assessee is a filer or a non-filer. If the other party is similarly, they may introduce, the government may put a link in the website so that it will enable us to see whether the other party is a filer or a non-filer and what rate we have to deduct TDS. Let us hope so, because this link, the link which I have given, relates to 194N, which helps us to check whether you give the PAN and it will say whether the assessee is a non-filer or a regular filer. Similarly, some provisions the government may introduce so that, but one thing we have to tell the client, this is a new provision. Before deducting TDS, you have to see whether the person is a regular filer or a non-filer. But one thing they have mentioned, aggregate TDS should be more than 50,000. In small cases, it is not required. Aggregate TDS of that person, if it exceeds 50,000 rupees, then see whether he is a regular filer or a non-filer. Provident fund, I've already explained that a ULIP policy we have seen. Similarly, PF is a situation, we all know this, because PF is a safe retirement benefit. So very conservative people, what they do is, in addition to what they are normally required to invest, the employees, I'm not telling about the employers, in addition to what they are normally required to invest, they invest certain extra amount. Suppose every month I am asked to invest only 10,000 rupees. I will not confine myself to 10,000. I will invest, say, another 25,000 or 30,000. Why? Because the interest income is exempt and I get a good return. Considering the present rate of interest, I get a good return, and that too exempt. This is what is plugged here. We have come across cases where people invest huge amounts to claim the exemption, which cannot be tolerated. This is what the government says. It is making its intentions very clear. We don't want exempted incomes and we don't want to promote savings. We want spending. The intention is very clear. They say, if you invest more than 2.5 lakhs in a year, on the excess investment, only prospectively, on the excess investment, the interest portion will be liable for tax. How to compute? Again, some softwares will be there. So there will be an opening balance corpus. Up to this year, some investment will be there. Current year investment has to be split between 2.5 lakhs and the balance amount. So interest on the opening balance will be exempt. Current year investment up to 2.5 lakhs, what is the interest? Interest on 2.5 lakhs, that is exempt. Balance amount, I have given an illustration. This year also it's easy. From the next year, opening balance plus current year's, last year's 2.5 lakhs, that is the opening balance on which exempted income. Last year's taxable balance, 3.5 lakhs. On that, what is the interest? So it is going to create a lot of calculation confusions. The government has said we'll bring out the formula by way of notification, we will notify what is the formula for calculating the interest, which is liable for tax or otherwise. I think within the limited time, I think I have took some extra time, like what we see in the ISL football being going on, lot of 5 to 10 minutes injury time. Even beyond that, I took another 10 to 12 minutes. I apologize to the managing committee for taking some extra time. Anyway, I'm happy that I could finish the presentation. Unlike what happened to our finance minister last time. Finance minister started the budget speech and at last she fainted. And such things never happened to me, and I could healthily, happily complete the presentation. And I'm very happy that the members of the Trichur branch, the managing committee of the Trichur branch, all stood with me and patiently followed my presentation. And thank you once again. Thank you for the office bearers. Thank you, Anup sir and managing committee team. Thank you very much.
Yeah, thank you, Srinivas sir. But I must tell that in fact it's a very commendable thing that you finished the same in 2.5 hours in spite of the huge number of proposals that has been brought in the budget itself. Technically, I thought that it may be a half-day seminar itself. Now, moving onwards, quickly, shall we find some time to just address members' questions, sir? I can just, if you just open the Q&A box. Should I read it for the members' benefit, general benefit?
You can read it, it's fine.
Yeah. The first thing I can take is that it's a general question. If the NRI worked in a non-taxable country like Saudi, what would the implication of his retirement benefits after he became resident in India?
Exactly, this issue was deliberated by the CBDT chairman after the budget. The live streaming was there in Twitter. He said CBDT is working on that. They'll come out with country-specific notifications on this aspect, and based on that, its tax treatment will be determined.
Okay. Now, the second question, whether the cash receipts or payments for exemption from tax audit refers to turnover or all those including loans.
The tax audit, what I understand from the question is whether all the categories of tax audit are covered under this cash scheme. I don't think so, because tax audit section 44AB, if we see, up to 1 crore is one category. 1 crore to 2 crore, 44AD deviated cases coming back is another category. Then 2 crores to 5 crores, that is a third category. Then profession is another category. 44AE coming back is another category. So different categories wise we have to analyze. And ultimately what happens is, this will become a tangled rope. We see in Tinkle and Balrama that we have puzzles showing the way from one end to another end. Ultimately, we end up nowhere. So because the 44AB, that's why at the outset I told you that 44AB tax audit is easier compared to determining whether the assessee is liable for tax audit, under which provision. To his specific query, I say this particular amendment applies to a turnover criteria spreading from 1 crore to 5 crores. In such a case, 5% of turnover is permissible cash receipt, not only sale, cash receipt. And similarly, 5% of expenses, total payments, 5% of total payments, not turnover, 5% of total payments is permissible expenditure. It can even be capital expenditure. 5% of total payments is the permissible cash payments. Similarly, once it gets enhanced to 10 crores, it will turnover 10 crores, receipts, total payments 10 crores, expense. We have to correlate. This is what I could say based on the understanding of the question.
Yeah, because the query has been opened by CA Nagarajan. So the sir is also concerned that if this exemption of this tax audit is given like this, they're like sections like 210 SS, T and things, others will go unnoticed. So why the government is encouraging like this is his concern that he has expressed. Now, the next question is that from Zakir sir is the threshold increase of 10 crores for 44 AB applicable to professionals? If
No.
professional has a turnover of 2.2 crore and to satisfy the condition of restriction of cash, would he be subject to 44 AB audit?
Professionals is a separate subsection. There the limit
Yes.
is 50 lakhs itself.
Yes.
It is not changed.
Okay.
Unless if, less than 50 lakhs means 44 ADA non-compliance coming back to 44 ADA. That remains the same. Professionals they have not touched. Only amendment vis-a-vis professionals is a limited liability partnership is not eligible for 44 ADA.
Now, our learned senior member Nadeshan sir has expressed a query. If capital asset is given to the partner at the time of dissolution or otherwise, will balance in capital account be relevant or not? In such
If
cases,
capital asset alone is transferred, it's not relevant. If capital asset alone is given, it is not relevant. That fair market value of the asset minus at what cost the asset was acquired, the difference is liable for capital gains.
Okay. In case money is given to partner at the time of dissolution or otherwise, excess amount over and above capital balance is treated as capital gains.
Yes.
Has any method been prescribed for such computation? Is it correct that it speaks of exclusion of increase in capital due to revaluation, etc.? Should value of intangibles to be excluded in arriving at capital balance?
That's what the intention of the government. They say whatever is in the books, you settle it. If you settle something more, you pay the tax on that. Any other method will end up as a dubious device, and we'll be inviting further troubles.
Okay. Now, the last question, because of the paucity of time, the last question from Shashi sir is relating to the 194P section. I must mention that I found your Facebook live quite interesting about that 194P. Please continue to post such bits. Now, the query from Shashi sir is a resident senior above 75 years gets a family pension together with individual pension. In this case, whether a family pension will also be treated as a pension and the person can leave away from filing return, or since family pension is classified under other income, should
family
he file?
Pension is computed under income from other sources, and surprisingly, the word pension is not defined in the Income Tax Act. 17(1) defines salary includes pension, but pension is not defined. General Clauses Act, we have to see whether family pension falls within the meaning of. I'm not aware of that, but it's a new insight for me. Similarly, one client of mine raised another question. That particular person is an ex-serviceman. He was a doctor in armed forces. After that, he became a professor in the medical college. So he's getting two pensions and two different banks. He asked whether if he changes the pensions to the same bank account, is he eligible for the scheme? Again, we have to see. We have to wait for the clarifications from CBDT. And invariably, CBDT will come out with a circular in the form of an FAQ. And most of these questions will be addressed. Let us wait for 2 or 3 weeks. CBDT is bound to give clarifications in the form of FAQ. If FAQ is not received, let us use the Twitter handle of the CBDT. We'll ask the questions to them. Let them come back. It is advisable if such query is there. Such query, let us directly shoot it to CBDT so that they can use this query for the purpose of formulating their circular. So
that's the end of the questions. Anup sir, can I just hand over the floor to you?
Yeah. So we can conclude. Prashant, it was a very nice presentation because you touched upon all the amendments in detail, taking very few time, considering the number of amendments as rightly pointed out. It should have been a half-day session, but you covered it really well, and it was very useful for me personally because that 194Q clarification was very useful. To stress it once again, if buyer deducts TDS under section 194Q the seller need not collect TCS under section 206C1H. So this was a new information for me. I was thinking that both are applicable. Both sections are applicable together. In that case, also see a lot of working capital of our clients would be blocked in TCS as well as TDS. So I'm literally relaxed now because after hearing that. And I support your two concerns. The first concern is, yes, the government is discouraging investments. That's true, because a couple of years ago, again, they introduced a new slab wherein not with those who are not availing ATC and all, they have a special slab. So that means they are discouraging investments. So your concern is absolutely right. And with respect to the tax audit, definitely the government is going to increase the tax audit limits in the future. So members should be really up to that. They should be prepared for that. No doubt about that. So Prashant, you are spot on with respect to those 2 points. So on behalf of Thrissur branch, all the members in Thrissur branch, definitely Prashant, you did a wonderful job. We are very thankful to you. And now for a formal vote of thanks session, let me call upon the secretary, C. Ajit Kaimal, for the same. Over to you, Ajit.
Thank you, sir. So, good evening, members, once again. So that as everyone told, budget 2022 had given a very feel-good factor, taking into consideration that no COVID-related assess or increase in tax rates has not been proposed by the government to shore up that pandemic enforced dip in the government coffers. Now, some of the proposals such as this taxation on to relaxations to NRIs, pre-filling of returns, advance tax on dividend income, amendment to section 44AD, now setting up of the new dispute resolution committee, all these are welcome, but some relaxations such as IT relaxation for these senior citizens of 75 years old are quite perplexing. But I must do comment that some hidden bombs has been incorporated in the finance bill, like this TDS at the rate 1% on purchase of goods exceeding 50 lakhs, provision of this higher TDS TCS rate up to twice the applicable TDS rates in case of non-filers, treating any flagged information in accordance with the risk management parameters of CBDT, non-consideration of goodwill of business as a depreciable asset, to name a few. Now, today's VCM by our learned faculty CA Prasanth Srinivas covered all the direct tax proposals in a very detailed manner. I observe that each of your slide contains very lucid examples. I can take it as a Bible for direct tax proposals for 21 straight away. I must mention that, sir, you have been a speaker for the same session last year, and now you are one of the recognized go-to experts on direct taxes in Kerala. On behalf of the branch, I would like to thank CA Prasanth Srinivas for the presentation and the time spent with us. It was quite fruitful. Also, on a personal note, please continue with your Facebook lives. Thank you once again. Now, thank you, Chairman C. Anup, for chairing the session, and also thank you, Vice Chairman C. Irene KK, for the intro. Thank you, dear attendees, for the support. Thank you all once again. Stay safe.
Thank you, Prashant.